Okay. So I think the conclusion there is this model is messy, right? And no matter how much you know, it's still an estimate. Think about actuaries. We think actuaries are these wonderful people that can predict the future, right? If that was true, why do we always have actuarial gains and losses? Because they're always wrong. It's no different with IFRS 9. I don't care what model you use. I don't care how good your statistician is. They're still going to be full of nonsense, right? And all that we can try to do as time goes forward is to try and get these models to be fine-tuned. It's early days. I'm sure if I talk to a partner 10 years from now, he'll say, oh my God, back in the old days, and they'll have their war stories. This is the war story days, right? When we come to 2030, when you become a bit older, you'll be able to say, back in the time, we had to do all these funny things, but now we have these models. Or we might say, we threw them in the trash can because they don't work, and went back to the incur loss model. I don't know. It's early days. Now, let's go through the measurement section as well. So I'll try to finish by 5:30 so you can go for dinner later, right? Okay. Give me your credit card, right? Now, what we basically did here is we changed the approach. Because in the old days, we had these categories that were very rule-based. So this part of IFRS 9 is principle-based. In the old days, we had this concept of amortized cost. What was amortized cost? You originate the loan. And then we had this concept of held to maturity, HTM. And then we had this concept of tainting. Remember all this kind of nonsense? And then available for sale. So it was very rigid and rule-based. I mean, if you originate a loan, it was an amortized cost. We didn't look at the fact of whether you would sell it or not. So this standard, this part of IFRS 9 is really good. So we have this concept about payments of principal and interest. And the issue is, if payments have principal and interest, there's a certain type of treatment. So if you have a share, can shares have interest? Well, if it's a preferred share, it's classified as debt. So it's possible, right? So some types of preferred shares are effectively debt. But when you talk about common shares, no. So when you have common shares, they're always going to be no principal, no interest. They're fair value to NI, to net income. That's the default position. The change previously is the default position was fair value to OCI. Now, fair value to OCI is an election. And what the standard says, it's a one-time, irrevocable election. What does that mean? You can't change it. You do it one time on a security-by-security basis. So, if you have principal and interest, and the buzzword is SPPI. Now, this is not so straightforward. So I'll go through SPPI in a second. I'm not sure how messy it was in Pakistan. But the problem in, for example, in Romania, the banks ripped off their customers. And do you do the same here? Quiet, huh? And because the banks ripped off their customers, they had all these other fees in the bank contract. And because they had all these other fees, the contract wasn't only principal and interest. And so what they did in Europe is the banks changed all their contracts. Well, it depends on the country. So Romania was a problem. Bulgaria was a problem. Because historically they had contracts that had a lot of punitive clauses in there. If you cancel the loan and go to another bank, there's a huge cancellation fee. Is that an interest payment? No. So if you have a huge cancellation fee, then the answer to the first question is no. So if you rip off your clients, you have to use fair value to net income. So if you have clauses in your contract that are not only interest and principal. So I'll go through those with a list. Okay? So I don't know in Pakistan, was that a problem here? It wasn't? So your fees all relate to interest and principal. And if I want to cancel my loan, the prepayment fee? And because the prepayment fee needs to be a compensation for my cost of funding plus a fair profit margin. That's interest. But if the prepayment fee is so big to prevent you to go to another bank, that's not interest. So okay, then it's an interest. It's a remuneration for your cost of funding, correct? That's interest. Okay, you're lucky because that makes it easier. Thank you. What's that?
We are good banks.
Yeah, I'm not surprised. It's a smart country. I noticed when I go to Saudi Arabia, I noticed that. So, if we have principal and interest, the questions are: is it only principal and interest? If it's only to collect principal and interest, we use amortized cost. So we look at a business model. And the business model is saying, now the business model is a bit different. It's hard to manipulate. Because I hear people say, well, we'll just change our model. You can't really do that. Because if you're a bank, these models are set by senior management. They're not so easy to just have a meeting and change them. So, for example, if you take a loan for a house and you want to get a mortgage and you're in the United States, I don't think it works this way here. The way it works in the U.S. is the bank will lend you money based on predefined criteria. What the bank will do is take those loans and group them based on certain parameters. So if you have loans where the credit score is between 800 and 850, they put those in a package. They get securitized with Freddie Mae, Fannie Mac, those securitization arms, and sold. So the business model in the United States is banks don't lend their own money. Banks make their money because what the bank does is they charge, so let's say that in the U.S. the mortgage rate is 4.5%. The bank will keep 1% and they'll give 3.5% to the owner. And the 1% is a servicing fee. So the way banks make their money is the servicing fee. Clear? Now you go to the bank and you want a loan to buy a house in America. So if I get a loan in America, the interest rate is about 4%. If you get a loan, what's the interest rate? Any idea? Do you know? No, in America I'm saying. For you, if you don't have a U.S. passport. For you, the interest rate is about 8 or 9%. So for non-U.S. citizens, the banks lend 8 or 9%. So if I'm a bank and I want to give you a mortgage, I'll say he's a partner, he's making good money. However, that loan cannot be securitized because a securitization is done through a U.S. agency and you don't qualify because you're not a U.S. citizen. So those loans, the bank lends their own money. They're a portfolio lender. So those business models are set way high up. So if anybody tells you, I'll just change my model, they're talking nonsense. You can't just change your model casually. Now sometimes banks do change their model. You may go from a portfolio lender to a securitization. It's possible. So the issue here is business model. So if your model is to only collect principal and interest, it's going to be amortized cost. It's much more robust than the previous standard, right? So if you look at my handout, if you look at question number 2 on page 104, question 2, page 104. Just part 1, please. Just part 1. Just part 1. I gave you a card, right?
Yeah. Thank you.
Did I give you a card already? I already gave you, right? Just part 1. Did I give you already? I gave you, right? I gave you. So, under IAS 39, what would you do here? Under the old standard for Part A, what would you do? Loan receivable amortized cost, right? Under the old standard, the emphasis was more how it was originated. If you originate it, it's a loan and receivable. If you buy it, you then have the HTM criteria, right? So the classification was based on how it was originated. Now, under IFRS 9, we don't care how you originate it. It doesn't matter. This is what my business does in India. So the way it works in California, if you get hurt at work, you're entitled to go to a doctor, and the company must pay for it. Now, if you go to a doctor that the company recommends, the doctor bill gets paid very quick. If you go to a doctor that your lawyer sends you to, what happens is those doctors try to charge a huge price, and it becomes a fight. And it takes sometimes 2 to 5 years for a doctor to get paid in this specific space. So what these doctors will do is they will oftentimes sell their receivables to specialist investors that have a collection machine, and they subcontract the collections to me. So what the doctor does here is they do the work, they issue the invoice, the ones that get paid, c'est la vie, and the ones that don't get paid after a period of time, they sell them, right? So here we have a mixed model, correct? It's to collect and sell. So in this example, what's changed is in the new standard, when it's collect and sell, it would be, it's a mixed model, it's fair value to OCI. If it's not held to collect and sell, then it's fair value to net income. So that's how the classification works. There is, we spoke about this a few minutes ago, an irrevocable election. What the standard says is you can use amortized cost for debt or equity if it reduces a measurement or recognition inconsistency. So I'm trying to think how we argue this for the microfinance. I think what they chose to do is if you fair value both the funding source and the loans, and they're both fair valued, that's, I think, I have to go back and get my notes out. Generally, banks don't do things at fair value, right? But it was a microfinance, and it was kind of messy to use the ECL model. So that was a workaround. Again, a while ago when the standard first came out. So the classification and measurement, SPPI, is a test, and the key thing there is we need to make sure that all the cash flows only are SPPI. So one of the things the auditors will be doing is checking this. So, and if they're not SPPI, it's going to be fair valued. And banks don't like to fair value loans.
So, as we were discussing earlier, there could be a smaller kind of payment at the termination or early termination of your contract or the loan agreement. So, even if it is small, instead of a huge punitive amount, will it still be kind of a disqualification from this?
Okay, so SPPI, payments of principal and interest. When you have any payment necessary for a normal loan is in this category. So if they charge a fee for a valuation, is a valuation necessary to get a loan? Yes. And as long as the valuation has a normal margin on it, that is part of SPPI. If they charge documentation fees to pay for the notary cost, and it has a fair profit margin, that is SPPI, right? If they have a cancellation fee, the idea of a cancellation fee is to reimburse the company or the bank of any of their lost cost of funding. So as long as the profit margin on the cancellation fee is commensurate with the cost of funding or the lost cost of funding, that's okay. Where you run into problems is when the cancellation fee has nothing to do with cost of funding. It's just an arbitrary number. It's 10%. Or, well, maybe 10% here is different because you have high interest rates.
Yep.
So
say, for example, 3 months interest worth.
Yeah. And you could probably argue that 3 months interest is a cost of funding compensation. Because when you give loans, you also commit funding for those loans, and you match it all up. So it's all about, 3 months would be reasonable, right, for cost of funding? Yes, I would think it would be.
Depends how you structure your product.
Yeah. But where I see it's gone wrong, in Romania they had like 10% cancellation fees when the interest rate was 5 or 6%. So the interest is 2 years interest effectively.
Okay.
So the cancellation fee was so punitive, you would not cancel. Like in my contract, it says, if I pay the loan with my own money, there is no cancellation fee. But if I choose to go to another bank, the cancellation fee is 10%. That has nothing to do with the cost of funding. That means that loan cannot be at amortized cost. It has to be at fair value. If there is any contractual feature, so what the auditor should be looking for is in your contracts with your clients, any part of the loan contract that has nothing to do with time value of money would make the entire contract disqualified at amortized cost. So I'm surprised you had no issues here. I thought you'd have some. But it was a big issue in Central Europe. It was not an issue in Germany. So what I've seen is in the more advanced economies, it tended to be not an issue. And then you see in the, Romania, Central Europe was a bit more, not, it's still Europe, but it's a different part of Europe, you know what I mean? So that's how we look at that. So the business model is determined by IS-24, your key management. So if anybody tells you, I'll just change my model to change my accounting, you can't really do that. Unless you're a one-person bank. But generally, banks are large. You can't play with this.
I think in our part of the world, in this country, over the period, products have matured and they have converted into structured departments. Our trading book is different.